Welcome to the deep dive. Today, we are strapping in for what feels less like a stock analysis and more like, I don't know, a high-stakes financial thriller.
That's a good way to put it.
And it's all centered on one company. MongoDB, ticker MDB.
The ultimate battleground stock of the quarter. Absolutely.
It's a company just defined by this explosive growth, these radical strategic pivots, and valuations that are so stratospheric they invite immediate, furious debate.
It is a truly high-octane situation, and that volatility, it just underscores the stakes. I mean, we saw MDB shares just blast off.
Oh, yeah.
They jumped over 22% in pre-market trading right after their latest quarterly numbers came out.
And that reaction, it just perfectly crystallizes the whole conflict, doesn't it?
It does. On one side, you have these passionate, almost evangelical believers calling the company a future Moneybase.
The Moneybase, yeah.
Destined, they insist, to the moon as, the foundational layer of the entire AI economy.
And then on the other side, you have the equally vocal skeptics.
Oh, yeah.
They look at that same chart and they just see a fundamentally bloated ticking time bomb.
Right.
Especially when they see the stock trading, well north of $400 for a tech company that, on a purely traditional accounting basis, isn't consistently profitable.
The debate is just brutal. It's polarized, and a lot of the time it feels like it's ignoring the actual data.
Which is exactly why we're here. Our mission today is to anchor these sensational claims from the $480 price targets all the way down to the most cynical valuation warnings to the cold, hard numbers that they presented in the Q3 fiscal year 2026 report.
And then from there, we have to ruthlessly scrutinize two massive interconnected strategic shifts that MDB is going through.
The first being that surprise yet, managed leadership shakeup at the CEO level.
And the second, this massive all-in technological gambit on the AI data plane, which is specifically being driven by their Voyage AI acquisition.
So we've assembled an arsenal of source material for this deep dive. We have the financial reports themselves, detailed analyst notes that are throwing out these wildly divergent price targets.
And that detailed breakdown of exactly what technical advantage MDB believes it bought when it vertically integrated Voyage AI.
Let's unpack this financial war zone, starting with the quarter that single-handedly ignited this recent blast-off.
If you needed just a single piece of evidence to justify the sheer magnitude of that post-earnings stock surge, it is the Q3 FY 2026 performance. We're talking about the period that ended October 31st, 2025.
And this wasn't just a modest beat, was it?
Not at all. It was, and I'm quoting several analysts here, an operational demolition of expectations across the board.
So let's start with the bottom line, the EPS. The non-GAAP earnings per share came in at a staggering $1.32.
Right. Now, put that into context for a second. The average analyst estimate was significantly lower. They were braced for only about 81 cents.
So that is a 67.09% positive earnings surprise. 67%.
I mean, that kind of overshoot is not common.
No.
It suggests either management was being extremely conservative in their guidance, or the underlying business achieved a level of operational leverage that just took everyone by surprise.
And it definitely points to the latter. We'll get into the mechanics of that leverage in a bit.
Okay.
But first, let's look at the top line, the revenue strength, which was, equally impressive and really signaled this robust continued demand.
What were the numbers there?
Total revenue hit $628.3 million. That's a 19% increase year over year.
And crucially, that substantially exceeded the very high end of their own guidance range.
Exactly. Which tells you that customer consumption was actually accelerating through the quarter.
But the real story here, I think, the absolute core of the bull case, it isn't just in the total revenue. It's in the performance of their flagship product, MongoDB Atlas.
100%. Atlas is the cloud. It's their consumption-based offering.
And we have seen Atlas have momentum quarter after quarter. But the fact that its growth accelerated in Q3, that is the critical signal the market reacted to.
That acceleration is the golden ticket.
It is.
It's why the company's demanding such a premium valuation.
Atlas revenue growth accelerated to 30% year over year. That's up from 29% in the prior quarter.
Okay, so to accelerate growth when you are already operating at a massive scale.
And Atlas is massive. It now represents a dominating 75% of the company's total Q3 revenue.
So to do that is just incredibly powerful.
Yeah.
Okay, let's unpack the significance of that 1% acceleration, though. Why does moving from 29 to 30% growth for a segment that's 3/4 of the entire business, why does that act as such a powerful catalyst?
Because it completely defeats the laws of large numbers.
Right.
As a business segment matures, its growth is supposed to decelerate, or, at best, it remains stable.
And acceleration at this scale signals that MDB is successfully winning massive new workloads.
Exactly. That new revenue is outweighing any natural slowing of their older accounts.
And the sources are pretty clear that this acceleration is tied directly to capturing the early stages of generative AI development, right?
Yeah, that and these large-scale, multi-year digital transformation projects that, well, they just necessitate a shift away from legacy databases.
So you have new customers adopting Atlas, and existing customers are expanding their usage faster than anyone anticipated.
Which demonstrates this sustained high-margin consumption growth, and it validates their entire cloud transition strategy.
That momentum brings us right to the second major point for the bulls: profitability and margin expansion.
Right.
This company isn't just growing wildly, it's proving it can actually control the costs associated with running a high-speed global cloud database service.
Absolutely. And the metric that truly defined the quarter for anyone who believes in their profitability is the Rule of 40 plus bull.
The industry standard for elite cloud software companies.
It demands that the combination of your revenue growth percentage and your non-GAAP operating margin percentage, that number has to equal or exceed 40.
And MDB delivered this again?
Correct. They delivered this for their second consecutive quarter in fiscal year 2026.
So with 19% revenue growth.
And a non-GAAP operating margin that expanded 40 basis points to 19.6%.
You get a combined rate of 38.6%.
Right. But the sheer magnitude of that profit beat indicates they are operating squarely within that high efficiency tier.
So for every new dollar of revenue, they're retaining a higher percentage of profit than they were before. It just demonstrates extraordinary capital efficiency.
Yeah.
Let's dive a little deeper on that operational leverage, because this really addresses the core criticism we hear all the time.
Okay.
Non-GAAP income from operations. It hit $123.1 million in Q3. That was roughly 59% above what the street was expecting.
59%. It's a huge number.
So what specific levers are they pulling to get such a massive beat on operating income?
Well, the leverage comes from primarily two areas: infrastructure and sales.
Okay.
As Atlas scales, the cost of serving each new customer diminishes. They've optimized their underlying cloud infrastructure, so their platform is just cheaper to run at scale.
And on the sales side?
The developer-led growth model, where developers adopt the product first and sales comes in later, is incredibly efficient.
So the costs to acquire a customer are spread out efficiently across this vastly expanding customer base.
Exactly.
Yeah.
It effectively turns that high-volume developer adoption into meaningful enterprise scale and, bottom line profit.
But this brings us back to the skeptical argument.
Right.
The bears repeatedly point out the stock is bloated because the company is, quote, not even profitable on a GAAP basis. We need to hit that GAAP versus non-GAAP contrast directly.
It's a critical nuance, and it revolves almost entirely around one thing: stock-based compensation, or SBC.
So MDB achieved a GAAP net loss of only $2 million this quarter, which is, it's virtually break even.
Right. But non-GAAP measures, they strip out non-cash expenses, and the largest of those is SBC.
Which is essentially how a high-growth tech company recruits and retains top talent, especially in engineering and sales.
It's their primary tool. So the company is profitable based on the cash generated by the underlying business operations.
But once you account for the expense of paying employees with stock, they show that tiny loss.
Exactly. For investors in hypergrowth software, the non-GAAP metric is usually preferred because it shows the efficiency of the core business model, excluding the compensation methods they use to fuel future growth.
But the bear case is still legitimate. SBC dilutes existing shareholders, and if the stock price drops, that compensation method becomes way less effective.
And that could lead to future retention issues or just require greater cash payouts. But the fact that the GAAP loss was reduced to just $2 million, it strongly signals they are on the cusp of GAAP profitability, even including those massive SBC costs.
So the $1.32 EPS beat is the financial anchor for the bulls, while that tiny $2 million GAAP loss is the thin ice the bears are standing on.
That's a perfect summary of the tension. And lastly, on the financials, the company looks financially bulletproof, really, regardless of how you calculate profitability, because of its phenomenal cash flow.
Cash is king, and it sounds like MDB is wearing the crown.
The cash generation was exceptional and, frankly, unexpected. Free cash flow, or FCF, it just dramatically surged to $140.1 million in Q3.
Wow, and that's up from what?
It was $34.6 million in the year-ago period. A major leap.
Which indicates high-quality, efficient revenue is coming in, and it gives them immediate capital flexibility.
And they used it. They successfully leveraged that financial strength during the quarter to redeem their 2026 convertible notes.
Which means?
They effectively wiped all debt off their balance sheet.
Wow.
As of the end of the quarter, MDB was sitting on a massive $2.3 billion in cash equivalents, and short-term investments.
And in today's environment, where capital costs are high and macro instability is still a threat.
Being cash-rich and debt-free provides immense financial resilience, and it gives the new leadership team a lot of strategic flexibility to fund acquisitions or expand sales infrastructure without any external pressure.
So we've established the foundation for the whole Moneybase thesis. You have accelerating growth in the core cloud business, proven operational efficiency with the rule of 40-plus SIPPetide, and a fortress balance sheet.
And the market response, through the analyst actions, was immediate and aggressive.
It was a feeding frenzy of bullish upgrades.
The analysts clearly decided that the performance in the new strategy, well, it validated paying a massive premium for the stock.
Goldman Sachs, for instance, raised their target significantly to $475.
Right, maintaining a strong buy rating. And Needham and BOSI Securities were even more aggressive. They raised their targets all the way up to 480.
Okay, so why are these targets, which are, they're multiples higher than traditional software valuation benchmarks, why are they justified in the eyes of these top-tier firms? What's the core rationale behind a $475 price tag?
The justification centers entirely on two factors: durability and market share capture.
Okay.
When a software company proves it can achieve that rule of 40-plus metric consistently, it moves into this elite class where, traditional valuation models like PE ratios are often just thrown out the window.
So the premium valuation is justified by the expectation that MDB will just continue to efficiently capture market share in a multi-trillion-dollar industry.
The entire enterprise data layer. They're betting that this efficient growth will eventually translate into massive, sustained GAAP profitability once that SBC is normalized.
So they're pricing in years of predictable, efficient market expansion, especially with the AI wave fueling it.
That's the bull case.
But the moment we introduce that premium, we hear the roar of the skeptics. We have to introduce the bloated bomb view. The valuation is the single most common reason for the bear attacks.
The frustration is palpable because, to a value investor, the price looks completely untethered from reality.
We saw comments directly from the sources questioning the surge. One said, serially, $400. With little capex going on and not even profitable, face the balance sheet facts. It's extremely bloated now.
Right. They see a stock trading on pure momentum and hope, just totally disconnected from current earnings power.
And that sentiment that this valuation is simply untenable, given the traditional metrics, it's powerful. Where else do we see this skepticism reflected by the analysts?
Well, while the 480 targets dominate the headlines, the more conservative views act as a crucial anchor.
Right.
Morgan Stanley, for instance, maintained a much lower target of $325. And Mizuho Securities, they kept a neutral rating with a target of $310.
And these analysts, they're not saying MDB is a bad company.
No, not at all. They believe it's a high-quality company, but they use more aggressive discount rates or apply a lower terminal growth multiple.
So they're essentially betting that the growth will slow down faster than the bulls predict.
Exactly. They argue that the execution risks and the competitive threats are just too severe to justify a nearly $500 price tag.
Our sources even indicate the analyst sentiment goes all the way down to $170. We need to understand the rationale for that extreme low end.
Yeah.
Who is calling for a 170 price target, and what do they fundamentally believe will go wrong?
The lowest targets, that 170 range, they come from models that fundamentally assume MDB's strategic pivots fail entirely.
A complete failure.
A complete failure. They assume that the hyperscalers successfully commoditize the document database layer, basically treating it as a feature, not a platform.
And in that scenario, MDB loses its pricing power, the Atlas growth rate decelerates back into the teens,
and the premium valuation just evaporates. They're pricing MDB as a niche database provider, rather than the foundational AI data layer, which reduces the multiple levels you see with more mature, slowing software companies.
So the core conflict isn't about whether MDB is executing well today. The numbers prove that they are. It's about whether that execution justifies a price tag that is pricing in years of flawless, high-speed execution against the global tech giants.
Precisely. They're priced for perfection. Any misstep in this next major phase of their growth could trigger a massive correction.
And that phase starts with the new leadership and their mandate to fundamentally change how MongoDB sells its product.
Right. This was the biggest organizational news this quarter, the changing of the guard at the top.
And this kind of sudden, though managed shift can send a high-flying tech company spiraling if it's not handled perfectly.
The transition was significant. David Icharya, the CEO, who had been with the company for 11 years and guided them through that successful 2017 IPO.
He retired.
He retired from his full-time role, effective November 10, 2025. It marked the end of an era defined by building the company from really a niche open-source project into a cloud powerhouse.
And the sources make it very clear this was a managed succession, which is critical. Icharya is staying on the board and serving as an advisor.
And that's key. So how did the market interpret this massive change in continuity?
It's fascinating. The market not only accepted it, but actually affirmed it.
Yeah.
The announcement, which came just before the phenomenal Q3 results were released, saw MongoDB shares climb 2.81% in pre-market hours.
So investors viewed this not as a distress signal, not a fire sale, but as a proactive strategic upgrade.
Exactly. It's designed specifically to tackle the company's next stage of growth, that shift from developer-led adoption to C-suite enterprise dominance.
So who is the new commander chosen to execute this evolution, and what does his background suggest about their future strategy?
That would be CJ Desai, or CJ, who steps in as the new president and CEO.
And his resume is just tailor-made for MDB's current ambient.
Where was he before this?
He was the president of product and engineering at Cloudflare, focusing on scaling next-gen cloud infrastructure. But before that, he had a high-profile role at ServiceNow.
And that ServiceNow connection is the crucial piece of his story.
It was a massive success story in enterprise scaling. Desai was part of the leadership team that saw ServiceNow's annual revenue scale dramatically from $1.5 billion to a staggering $10 billion.
That achievement isn't just about engineering. It's about mastering the complex dynamics of selling multi-million-dollar software licenses to the world's largest companies.
Right. And as a fitting historical footnote, Desai actually built relational databases at Oracle 3 decades ago, so we have this deep understanding of the competitive landscape.
That's a powerful combination, scaling massive enterprise businesses and having deep database roots.
So his mandate is this pivot to MongoDB 3.0. What does that mean strategically? His mandate is crystal clear. Shift from a purely developer-led growth motion to expanding outreach directly to the C-suite for top-down enterprise modernization and migration deals.
So phase 1 was a great product for developers. Phase 2, Atlas, was about making it a cloud standard.
And phase 3, MongoDB 3.0, is about institutionalizing MDB as the strategic platform for core business operations.
This shift changes everything, though. The sales cycle, the required expertise, the amount of money you spend on marketing. It all changes dramatically when you go from winning over a single developer team to winning a multi-million-dollar contract that needs CEO and CIO sign-off.
It is an entirely different operational beast, and we see the type of deals they're targeting in the source material.
Like the Toyota case study.
Right, Toyota migrating major applications to Atlas on Microsoft Azure, or the Swiss private bank Lombard Odier using Atlas to modernize its legacy banking systems leveraging GenAI.
These are complex, multi-million-dollar contracts that involve displacing deep-seated legacy relational databases.
So Desai's primary job is to prove MDB can land these whales consistently.
But this brings us to what we're calling risk number 1, execution risk. Scaling a complex enterprise sales engine while simultaneously maintaining the momentum of the original developer model. That sounds like a guaranteed point of operational friction.
It is the single biggest operational risk facing the company right now, and it's one the bearish analysts are laser focused on.
The developer-led model, while efficient, it tends to hit a revenue ceiling.
Right. To get to $5 billion, $10 billion, and beyond in revenue, you absolutely have to master enterprise sales.
And that requires a massive, costly investment.
Huge. hiring specialized, highly compensated account executives with relationships in the C-suite, increasing the time and expense associated with closing a deal.
And managing a much longer sales cycle, maybe 6 to 18 months, compared to the rapid adoption cycle of developers.
So even if the revenue comes, the cost of acquiring that revenue, the investment in that enterprise sales force, is going to put pressure on the very margins that MDB just showed off.
It could temporarily slow the margin expansion and potentially undermine that Rule of 40 plus metric if the costs increase faster than the large enterprise deals close.
Exactly. And beyond that, there's the cultural clash risk.
Mm-hmm.
MongoDB has always been developer-centric, focusing on ease of use and documentation. Shifting focus and budget toward the C-suite could alienate the very developer community that built the company's reputation.
So Desai has to execute this balancing act perfectly.
It has to be perfect.
On the product side, though, Desai seems confident that MDB has a trump card against the established giants like Oracle. He talks about having a clear architectural advantage.
Yeah, and what he means by that is that the rigid relational database architecture, think Oracle SQL Server, it was built for a world of structured tables.
And today's applications, especially AI, require this fluid mix of structured data like customer IDs and unstructured data like legal documents or images.
Exactly. And MongoDB's document model naturally handles this fluid mix. Desai stated that their architecture wasn't, force-fitted for AI workloads.
Yeah.
It was designed for the very data diversity that future applications require.
But relational databases have spent decades establishing themselves. The cost and pain of migrating core banking or manufacturing systems away from Oracle or Postgres is immense. How does MDB overcome that enterprise inertia?
That inertia is the reason risk number one is so great. Desai is betting on two things: time and the sheer technical requirement of AI. He's arguing that the legacy databases require these complex, costly workarounds, integrating separate vector databases or trying to force unstructured data into structured tables, which rapidly increases the complexity and cost of AI applications.
So MDB's architectural advantage, coupled with their AI-specific integrations, aims to make that migration a clear economic necessity for CIOs who are under pressure to rapidly deploy generative AI.
Right. The Toyota and Lombard Odier examples are them proving they can overcome that inertia one massive deal at a time.
That strong connection between the new leadership, the enterprise pivot, and the AI narrative, it leads us perfectly into the final critical strategic anchor: the AI data layer itself.
MDB's bet is massive and unequivocal. They want to be the dominant data layer, the storage of choice for all modern workloads, especially generative AI.
And this fight is crucial because the underlying market is just exploding.
It is. The overall NoSQL database market, which MDB dominates, is projected to surge from about $15.5 billion in 2025 to over $50 billion by 2029.
That's a 34% compound annual growth rate?
It's massive, and that growth is entirely fueled by AI, IoT, and real-time processing needs that legacy systems just cannot handle.
So MongoDB Atlas already had vector search capabilities, which is the foundational tech needed for AI apps like ARG.
Retrieval augmented generation, right?
But they decided that wasn't enough, hence the vertical integration through acquisition.
Correct. And that's the Voyage AI acquisition, which they completed in February 2025. This was not a minor talent grab. This was the acquisition of a critical advanced layer of the AI stack.
So Voyage AI is a pioneer in state-of-the-art embedding and re-ranking models.
Exactly.
Okay, we need to slow down and make sure every listener understands this piece. Vector search is fast becoming a commodity. Everyone offers it. Why does specializing in embeddings and re-ranking move MDB from being a feature provider to building a strategic technical moat?
Okay, think of it this way. Vector search is just the storage closet.
Okay.
Embeddings are the highly efficient system you use to label and organize everything that goes into that closet. And re-ranking is the final quality control system that checks the labels before you pull something out.
So by integrating Voyage AI, MDB is trying to control the entire AI data pipeline, ensuring the quality and, crucially, the cost of the data retrieval are superior.
That's the whole game.
So let's define ORAG retrieval augmented generation simply.
ORAG is how you make large language models reliable.
Right, they hallucinate.
They hallucinate facts about your specific company data. RG retrieves relevant proprietary data from your database. In this case, MDB Atlas converts it to vectors using embeddings and feeds it to the LLM to ground the answer in facts.
And the quality of that answer is entirely dependent on the quality and efficiency of those embeddings and the accuracy of the final search results.
Which is exactly where Voyage AI comes in.
And the sources detail specific technical advantages MDB gains from this integration that translate directly into economic savings for their customers. These are the proof points for the bull case's AI narrative.
The first advantage is pure economics. Low dimensionality.
Okay, what does that mean?
Voyage AI produces vectors that are 3 to 8 times shorter than vectors generated by generic open-source models.
Now, imagine a global enterprise running a massive vector database for millions of documents.
Those tiny savings multiply into enormous reductions in cloud egress fees, storage costs, and network transfer fees.
So it's a direct, tangible cost benefit. It makes the platform economically superior for customers running large-scale Gen AI applications.
Absolutely. That addresses the storage and network costs.
And what about the processing and speed?
That's the second point, cost efficiency and speed. Because the Voyage AI models are highly optimized and smaller, they enable faster inference and lower latency. They're approximately 2 times cheaper for inference compared to using generic API calls to other models.
And for developers who are iterating constantly and running these apps in high-stakes production environments, where time is money and every API call costs something,
that economic advantage is massive. It reduces the total cost of ownership for running an AI application on Atlas.
And the final piece, which addresses the garbage in, garbage out problem you see with generic LLMs, this is where domain specialization becomes so critical.
And this is arguably their biggest technical moat. It's domain specialization.
So a generic model treats the phrase security offering the same way in a novel as it does in a legal prospectus.
Exactly. Voyage AI offers domain-specific embedding models tailored for high-stakes fields like legal discovery, financial services, and code retrieval.
This specialization ensures optimal performance for RA because the models are trained to truly understand the specialized meaning and nuance within that industry's jargon.
And that level of contextual understanding is what separates a generic, low-value AI app from a mission-critical, differentiated enterprise solution.
So MDB is essentially arguing, sure, the hyperscalers offer basic vector search, but we offer a full, optimized AI data platform that is fundamentally more efficient, cheaper to run, faster, and more accurate because of this vertical integration.
Exactly. They're trying to position themselves as the premium optimized layer necessary for any production-grade AI application.
But we have to address the 800-pound gorillas in the room, the hyperscalers. This brings us to risk number 2, pricing wars and commoditization.
Right.
AWS, Google, and Microsoft have infinite budgets and a clear incentive to destroy MDB's valuation.
And the threat is intense and real.
Yeah.
The hyperscalers have already made database plus vector search a baseline offering.
You're talking about things like Azure Cosmos DB, which offers an API for MongoDB, or Google AlloDB AI.
Yeah, and they're aggressive in their serverless pricing models, trying to commoditize the database layer entirely. They're basically giving away the database to make money on compute and storage.
So if the hyperscalers successfully imitate or commoditize the embedding and re-ranking technology, the heart of that Voyage AI ModeMDB's ability to demand a premium valuation will erode rapidly.
It would.
So what's MDB's defense beyond just Voyage AI? How does their architecture defend against an Amazon trying to offer a functionally identical service for 50% less?
Their defense is twofold. It's anchored in technical depth and their multi-cloud strategy.
Okay.
First, the technical gap. The sources highlight that these imitation APIs, like the one from Microsoft's Cosmos DB for MongoDB, are imperfect.
What does that mean, imperfect?
They do not offer full support for the latest MDB versions. They lack native MDB server-side code execution for advanced functions. And crucially, for large enterprise, they miss critical features like native JSON schema governance and advanced security patches.
So high-value enterprise customers who demand the latest security, governance, and features are sort of forced to stick with the native Atlas platform.
Right. The imitation is functional for small use cases, but it's insufficient for mission-critical enterprise deployment.
And the second defense?
Their unwavering multi-cloud commitment. MongoDB Atlas offers a genuine multi-cloud experience across AWS, Azure, and Google Cloud.
Whereas the hyperscalers are inherently biased toward keeping you locked into their infrastructure, that's their business model.
It's their core business model. For large enterprises seeking redundancy, geographical flexibility, and avoidance of single-vendor lock-in, which is a key concern for any CIO, MongoDB's cloud-agnostic approach is a massive competitive moat that the hyperscalers just can't ethically or functionally replicate.
As Desai noted, multi-cloud is here to stay, and MDB is uniquely positioned to capitalize on it.
That's the argument.
That makes sense. So the cost advantage of Voyage AI and the flexibility of multi-cloud are MDB's shields against the hyperscaler sword.
Okay, so if we synthesize the bull case, the investment thesis rests on this undeniable financial momentum, coupled with an aggressive strategic pivot that is perfectly aligned with the AI spending cycle.
Right. We have accelerating Atlas growth at 30%, which proves they are winning complex, high-value workloads.
You've demonstrated operational leverage by achieving the rule of 40 plus for the second consecutive quarter.
And they have a uniquely efficient AI platform thanks to the Voyage AI vertical integration, which provides both economic and technical advantages in RO.
That, combined with a debt-free, cash-rich balance sheet featuring that huge surge in free cash flow, it just paints a picture of exceptional financial resilience.
This is a company that can fund its own innovation, and that costly enterprise sales pivot internally, weathering macro storms better than many of its peers.
However, the risks, the ticking clocks that justify those extreme bearish targets, they remain substantial.
The market is paying a premium for execution, and any slip could be catastrophic for the valuation. We've already covered two major ones extensively.
Let's just quickly review them. Risk number one, execution risk.
Can CJ Desai successfully execute the pivot to the C-suite and land those multi-million-dollar deals without stalling the developer engine?
It's a fundamental organizational shift. They have to successfully ramp up the cost and complexity of the enterprise sales team, justifying that investment by securing massive long-term contracts.
And if they fail to secure these top-down deals, or if that expensive sales team cannibalizes the developer focus,
the revenue acceleration the market expects will fail to materialize, which would support those lower $300 price targets.
And risk number two, competition. The constant pressure from hyperscalers to commoditize the core product and imitate the Voyage AI moat.
Right. If AWS and Google successfully catch up and make high-accuracy, cost-efficient embeddings a commodity offering, or if they simply use their pricing power to undercut MDB's core offerings, regardless of technical parity,
MDB's primary AI moat could erode rapidly.
And they'd be forced to compete purely on price, which is a dangerous game against the largest balance sheets in the world.
And finally, a risk that's just inherent to the cloud consumption model that defines Atlas. Risk number three, consumption volatility.
Because Atlas revenue is consumption-based customers pay for what they use. MongoDB is acutely sensitive to sudden enterprise budget cuts or cost optimization efforts.
We've seen this vulnerability during periods of macroeconomic slowdown.
Yeah. When the economy tightens, CIOs immediately tell their team to cut cloud spending, optimize databases, and that introduces a quarter-to-quarter variability that pure subscription models typically cushion against.
And while MDB showed strength this quarter, that sensitivity remains a persistent vulnerability.
It does.
It's fascinating. You have this undeniable operational masterclass in Q3, yet you have this massive spread in analyst sentiment. The price targets range from the extremely cautious doomsday scenario, 170 low end, all the way up to 480.
And that spread perfectly encapsulates the ongoing uncertainty and the sheer high-stakes nature of this investment right now.
The market is fundamentally trying to decide whether MDB is a niche document database,
which justifies the low-end 170 targets,
or if it's the foundational data layer of the next decade of application development,
which supports the 480 high-end. The company has given the bulls the numbers they need today, but the future valuation hinges entirely on whether Desai and Voyage AI can deliver on their promises.
So this deep dive has shown us that MDB is simultaneously executing an operational masterclass, delivering that Q3 beat and the rule of 40-plus performance, and it's facing two massive existential execution challenges.
Right. Integrating a new leadership strategy focused on complex enterprise sales and successfully defending its specialized AI moat against the largest companies in the world.
The war for the cloud data layer will ultimately be won by the platform that proves most efficient at running AI workloads at production scale.
And MongoDB is staking its entire future on Voyage AI, providing that economic and technical advantage, specifically in the cost and accuracy of embeddings and re-rankers.
So the question for you, the well-informed learner, to consider is this.
Can their unique technical edge in these specialized AI components protect their premium valuation long enough to institutionalize their customer base through Desai's enterprise pivot? Or will the hyperscalers catch up faster than expected, turning what the bulls call a Moneybase into a simple and potentially bloated document store?
A question worth billions of dollars and one that rides entirely on the nuanced technical details of domain-specific AI models. That's all the time we have for this deep dive. Go explore the implications of those specialized embedding models.